All right. So we're talking about different ways to finance real estate. A lot of people think some things are not possible for them just because of what they do. You're a business person, and you might even have employees, right? And but you're trying to hide the money as much as possible so that you don't get pounded by taxes. So this is to kind of educate you on what's possible. And we're going to give you a roadmap, so to speak, with our two speakers to kind of guide you on what you can do to turn that thing around and start growing wealth for you and your family. All right. So we want to kind of start from this excerpt from this book, Think and Grow Rich. I mean, there's a reason why this book is a very popular book. It's been around for ages, and people read it because you don't get wealth by just walking. You get wealth by thinking and putting a plan together. And when you put a plan together, then you can navigate your way to acquiring the wealth. You know, it's just that, you know, if you think it through, possibilities, you know, comes up. And you'll see as we go along in this conversation. Okay. My name is Gary Nix. I'm a real estate broker for about 15 years. I am one of the presenters. I do have two co-presenters here. Matthew Franco is a financial person. He will introduce himself later on. And Chris Rivera is a mortgage person. These are people that I deal with that can actually help us navigate through this platform. All right, let's see. I'm looking at, I wonder if we should wait a little bit because I don't have a whole lot of people on the screen yet, right? Let's see. I don't want to go in. Should we just keep going? Okay. All right. This is kind of explaining what I've been doing. My passion is to really help educate people to get better with understanding everybody can tap onto the wealth. And real estate is a piece of wealth where we all can tap into. If you've got a job and you're working, you're making money, it's just thinking a way out to getting it done. And it's not just about holding one property. It's about, can you set yourself up well to have multiple properties so you can build, you know, wealth. The people that have done really well are people that not only own their home, right? You got to own your home first, but they also build wealth with owning multiple homes, commercial buildings. And some people may have a vision for hotels, motels, whatever that may be. But that's how you build wealth for you and your family. And why do we need to build wealth, right? It's like, why? It's a legacy. It's a great thing if you come into this world and your parents already set up stuff for you. So if you can do the same thing for others around you or others coming behind you, I think it's a great thing. Okay. Matthew, can you go ahead and introduce yourself?
Yeah, hey, how's it going? Yeah, my name is Matthew Franco. I'm a financial advisor with LPL Financial. Gary asked me to come on because I did the same type of presentation at his Keller Williams office a few weeks back. So I specifically work with business owners and their clients. So a lot of the times has to do with like real estate agents, clients, and things like that. But really how to kind of structure your business utilizing an LLC, an S Corp, and taking a look at some types of investment in retirement accounts, specifically geared towards business owners. So yeah, that's kind of my background. I'm based out of here in the South Bay. So
awesome, thank you very much. We'll come back to your presentation later, huh?
Yeah.
And Chris Rivera, can you go ahead and introduce yourself, sir? Chris, I think you may be on mute.
Gary, can you hear me?
Yeah, now we can hear you.
Okay, there you go. Well, hello, everyone. My name's Chris Rivera. I'm branch manager here at Len US. Been doing mortgages for a little over 25 years. I do residential lending, which is really just 1 through 4 units, whether it's owner occupied or investment properties, which we call non-owner occupied properties. Put thousands of people into homes over my career. And like Gary, I think it's a single greatest way to build wealth, to put roots in the community for yourself as well as your family, and really just to acquire as much wealth as you can to pass on to your children, which is what Gary was talking about, the legacy. I truly believe that as well. It's been just a great career path for me to be able to help so many people to attain wealth, to put them in positions where at some point in time they can retire and they have a nice stake in property that they can either sell and take the equity out and live comfortably the rest of their lives, or potentially paid it off and now they're living in the area that they want to for the rest of their lives. So, later on, I'll explain some of the programs that are out there for you, but I was really honored by Gary to be able to speak to you guys in regards to some of the self-employed borrower financing that's out there. So it's a pleasure to be here.
Thank you. All right. Okay, so this is all about owning homes, multiple properties. Again, I always say the first property, of course, you can have is yours. And from that point, there's always ways, once our mind, again, is thinking and growing rich. Once we open our mind up to possibilities, other opportunities come. But, we want to hopefully give you a platform where you can go this way, you can go that way, to continue to build a wealth. Okay. So you don't want to cut yourself off from the buying game. It's available. It's just getting the information. Information is the key, to everybody. I meet people in my life where, I don't know if I can own a home. And then we sit down, we start talking, and the next thing you know, we're getting them qualified and they buy a home. And then, sometimes I'm, doing open house, door knocking, and I'm talking to people like, what does it take for you to get a second home? And they just don't think it's possible. But once we get into the conversation, we find out it's possible, and we make, we start putting a plan towards it. So we just want to be in the forefront of that today, give you those information that hopefully will help you into knowing what's possible for you. And the key to this is to be purposeful. You can't wishy-wash your way into it. You have to really plan, like, okay, this is possible, and I'm going to do this, and I'm going to take this action and take that action to getting into it. And if you can sit down with a financial person, with a mortgage person, and we're going to give you some advice on what your CPA can do for you to allow you to do it. I remember I had a couple came in, their business is generating $250,000, and they create an income where they're making like $30,000. I said, why do you do that? That's just small mind thinking. What are you thinking about if your business generates this money and you don't invest the money? How are you going to grow? So it's all about that. Hopefully we'll get more into it. So credit score is a big thing. Some people understand it, others really don't just care about it. But this is kind of how the banks think of you as being responsible. You know, a lot of people think responsible is, okay, I'm taking care of my family, I'm taking care, I'm paying my bills. But, you know, really keeping your eye on your credit score, it really does matter. You have to fight for it. I mean, I've seen people come where their score could be super high, but they had they went to the hospital, you know, they had a copay, they refused to do the copay, now it became a collection. And that collection come up on your credit, it dropped you down 100 points in your score. It's just really being aware of it and make sure you're monitoring it, that something doesn't come up that's not supposed to come up. And you know, the key thing I tell people is just check your mail. Oftentimes things can be avoided by people just checking their mail. You know, okay, so you were supposed to make a payment, you didn't make it, they send you the mail like, hey, you did not make a payment. You say, oh, I have an automatic payment. Well, it didn't come true. Take care of it. You know, you take care of it, your score stays good. But it really does matter to have a good credit score. And you find out with the lenders, you know, anything you want to buy, having a good score helps you. If you want to buy a car, it helps you to get the best rate. You know, so I'm sure everybody wants to get the best rate every time they're making a financial dealing. But then let's take care of this one thing. All right. Okay, so a lot of people think in the now. What do I need to survive now? What do I need to do now? If my now is covered, I can forget about tomorrow. I'm gonna ask that you, again, let's think a little bit different. If we think different, we get different results. So we wanna think further ahead and say, okay, even if my now is okay, what would my 10 years from now look like? What would my 20 years from now look like? And if we can even go back to like, oh, when I retire, what would that look like? What do I want that to look like for me? You know, and that's the key, I really believe, to like, okay, if you see your retirement and you say, okay, by the time I retire, I want to be able to go out, you know, go on vacation, go meet, you know, my kids, my grandkids, go spend time with them, that kind of stuff, and have a good life. Well, what are you going to create to do that? And I really believe real estate is a good way to, you know, finance your life. If you have multiple properties that's bringing you income, you know, so now you're retiring, but money is still coming your way. And not only that, you can sponsor your children, your grandchildren, whatever that may be. When we think further ahead, I think it will motivate us to do more today. Because if we're just thinking about today, okay, I got food on my table, I got clothes on my back, all right, I'm good. But if we think further ahead, that will allow us to see more of what is possible for us today. Okay. So these are the things we want to consider for today. What can we do, especially, again, if you're a business person, independent contractor, you're on a payroll of 1099, you're making really good money, and you don't have a plan for today. These are things I want us to consider, okay? As a business person, you have to look at the property you want. The property you want is gonna determine the income you must have. Chris will allude to that later on. If you know you wanna buy a $600,000 property, a $1 million property, an investment property, you know, 700, 800,000. Well, what income must you show in order for you to do that? So rather than, you know, claiming zero on your income so that you don't pay taxes, look at what you need to show and how minimal a tax you need to pay in order for you to be able to do that. That's what this is going to enable you to do. Like, okay, if I want, a single family home, investment home, a condo, whatever that is, what income must I show on my tax preparation in order for me to be able to do that? So again, the income it would take to get that home, whatever that, so if you want, let me just give you an idea. And again, Chris will come in to make comments about, actually, Chris, maybe I can get you to make some side comments on this one. If one wants to buy, you're a business person and you're thinking about buying a $800,000 home, what kind of income do you want to show on paper? Let's say you have zero debt, but you want this $800,000 home. You've got, 10% down. What kind of income do you need to show for that?
Well, this is going to exclude any kind of debt load because we also have to take that into account. So I'm going to assume the borrower has no debt, no car payments, no student loans, no credit cards, completely debt-free other than their rent. If they're buying 800,000, putting 10% down, that means they've got a loan amount of about 720. I'm going to assume they have excellent credit. You're probably getting a rate of about 3%. So your total PITI on something like that, including mortgage insurance, is probably somewhere in the neighborhood of 720, probably about 3,000 a month. So you really only need to qualify with about a 45% debt to income ratio, which I'll cover later. So I would assume someone who's making somewhere in the neighborhood of like 7,000 a month net income would qualify. So that's about 84,000 a year. You should be able to get into a home like that if you've got 10% down with no debt.
All right. So that's what is good for us to know, that, okay, if our house is open, that, okay, this is the income I need to show, then you show that income and then you prepare for it. So that's why this is great for, is for you to know how much income you need to show based on what you want. Now, if it's an investment property, you're probably going to need to put 20 to 25% down. So, because I've seen a lot of people that have the money, but they don't show the income to qualify. And that's where we hopefully can get some guidance on how to do that today. So you want to create a wall of that income. Okay, if you have income coming in, but you've been writing everything off, so now you're only showing $30,000 in income, that's not going to allow you to do much. But if you have a good understanding of, okay, I need to show, $8,000, $10,000, since I make over $20,000, okay, so now I need to get with my CPA and say, okay, I need some write-offs for my business because I have business expenses, but I also need to show income in order to help me do this. And Matt is going to tell us the different ways you can go where maybe you don't need a write-off, maybe you just need to have a different plan on your business to getting the results you want. The dollars is always available. Is how we turn the dollars around, where we want to put the dollars to. It's coming in from here and there, and how you want to show, this is what you need to show in income so that the bank can feel comfortable that you can make the payment. I know people that rent and paying $4,500 in rent because they make the money, but yet they can buy a $3,000 mortgage. You can pay $4,500 rent, but you can buy a $3,000 mortgage because you are not showing the income. And it's really lack of information to think it's not possible, because it's always is possible. It's just getting the right information. And hopefully we'll have this recording live that people will be able to take with them and get this information on. It's really important to know that the taxes you pay is much less than the money you will need to spend. Let me say that again. The taxes you pay is much less than the money you will need to spend. Now, what does that mean? I've had files over and over where, okay, you have invoices, deposits of 200,000, but you're showing $35,000 in income because you don't want to pay taxes, right? But if you understand that, okay, if you write off business expenses and then you write off, sometimes I have people that have family of 5, but they're writing everything off. And because again, they don't want to pay the taxes. Like, okay, this is minimal taxes. So if you pay even $15,000 in taxes, and that $15,000 in taxes now allow you to show income of 100,000, right? And that 100,000 now allows you to go buy, your $700,000, $800,000 property that you can afford because of the money that's coming to you. It's just knowing where it is, because a lot of times people are like, okay, that $700,000 property, you might buy it for FHA where you only need like, $30,000 or $40,000 to get into that property. Whereas if you pay the $15,000 taxes, now you're only spending $40,000. On the other hand, if you're only showing $600,000 in income, when you could purchase an $800,000 property, now you'll have to come up with more money, to be able to buy the same property. So the taxes you pay, sometimes you just have to have an understanding. Okay, this is what I need. If I pay this, I can get that. Again, I'll let the expert talk about it in a little bit. So don't cut yourself out of building your wealth. Building your home, it's whatever you're showing, you show little, you get little. You show much, you get much. So you just need to know investment is available for you, really for everybody. I've been in my career. I remember this one lady I met makes $48,000 a year, and very focused, and say, okay, Gary, what do I need to do to not just get one home? I want to get 2 homes. I'm like, okay, I like that. And we put a plan, for her, and say, okay, you can go, let's go get a income property first, get an income property, and you stay in that, you rent that, the other unit out. 2 years time, you can now go into buying your own property. And we did that. So it's just, everything is possible. You just gotta be focused on what you're doing and the steps you want to take to get there. Okay. All right. Before we get to the case files, let me unshare my stuff. Okay. All right. Matt, have you take over at this point.
Okay, sounds good. Is there a way to screen share my screen so I can kind of go through some of the slides that I have?
I believe you're set up for it.
Okay, cool. Let me go through this then. All right. Can everybody see that?
Yep.
Okay. So basically what I want to go over today is really kind of like your business structure as a 1099 or a business owner, right? So we're going to kind of go through like why you should establish an LLC and an S Corp, some tax saving strategies by doing so, and then also some different types of investment and tax deferred accounts. We're going to jump over that Prop 19 just because that was for a different thing. But basically, really when it comes down to an LLC and S Corp, right, since now you guys are a business owner, or you guys have been a business owner, an LLC is kind of like an umbrella term, right? So within an LLC, you can be taxed 3 different ways. You can be a sole proprietorship, which is really not really doing anything special with your taxes. A C Corp, it's really meant for like larger corporations with more employees, and it's a little bit more complicated. And we're going to focus on the S Corp because that's really meant for like those that are self-employed, right? It's maybe just you, maybe you have a few employees on your payroll, but this is really where we're going to kind of go into today. Let's see, is that working? But yeah, the main benefits is it kind of separates you and your business, right? So it keeps your business assets separate from your personal ones. And then really where it comes down to is you're going to be saving a lot in self-employment tax because you can consider yourself an employee of your company now, right? And we'll get into like some exactly what that means. And the one is set up different types of retirement accounts, more specifically tax deferred accounts that can help you a little bit more on taxes. And we'll go into that a little bit as well. And you can be a little bit more creative with your tax deductions, set up your S Corp. So taxes. So this is really kind of what it comes down to today, right? When you file your taxes, and it's kind of a perfect conversation since tax season's coming up. When you file your taxes, different types that you pay, right? There's what's called federal, state, right? Because we live in the state of California, and then self-employment. The first two are, right, they're a little bit more simple. The more money you make or the more money you show, the higher tax brackets you're in, so the higher taxes you're going to pay, right? You can minimize some of those by doing and things like that. But the self-employment tax is really what we're going to focus on here today, because that self-employment tax, it's a flat 15.3%, right? And this is where a lot of business owners kind of complain about. And with that self-employment tax, it consists of your Social Security and your Medicare, right? So for an example, so let's say that your net profit for the year, right? Let's say for 2020 was 150,000. So this might be after like all your write-offs and things like that. So you might have grossed a little bit more, but after this is going to be your taxable income, right? That 150. So in this example alone, your self-employment tax would be about $21,000, right? Doesn't seem very attractive to do that. So that's where we're going to use the S Corp and as an example to kind of save on some of the self-employment tax. So now since you're incorporated and you establish your LLC, right? Now you want to consider yourself an employee of your own company, right? So you do this by W-2ing yourself. And in this example, we're going to split your income into two different categories, right? Your W-2, where you payroll yourself for the year, and then your K-1, which is your business income. So you do this because now the self-employment tax that you pay is only on the income that you give yourself for the year, right? So instead of having to pay the 15.3% or that self-employment tax of the 150, you're only having to pay that self-employment tax on the $50,000 that you payrolled yourself, right? So that alone is about a $13,000 tax reduction. But at the same time, there's pros and cons to doing so, right? Usually just to be, and a lot of popular question is like, well, can I just make my income go to $1,000, right? Well, the con of doing that is like Gary was saying that you show too less in income and you might not qualify for those houses that you might want to as far as mortgages goes, right? So this just goes back with planning and talking to your CPA as far as like, hey, if you're planning to buy that mortgage soon, then maybe you don't want to get that your W-2 income so low, right? And that's something that Chris could kind of touch upon as far as like where to put that income. But this is basically how you want to structure your business as far as like tax savings goes, right? We have another note on this. And then it's really not doing anything special. It's really just, it's more of like paperwork, right? It's just organizing your business more efficiently to kind of save on some of these taxes that you have. So everyone's situation is going to be a little bit different. Yeah.
So really on a situation like this, even if they made the whole income W-2, there are two levels where they save themselves. I know when I used to do self-employment tax, I used to get killed at the end of the year because I didn't have enough money saved up, right? When you put yourself on W-2, that money is being taken off right away. Yeah. So you don't really owe any money on taxes. You see what I'm saying? So that's another thing people need to know. It's a lot of people, the money they're making, money, the business is going through, it's like great. And you think that money is coming. And then at the end of the year, like, oh, I got to pay these 15% tax. And then they're crying, right?
Mm-hmm.
But if you put on W-2, as a W-2, your taxes have been taken up front. So at the end of the year, you're not worrying about, oh my God, I got to pay taxes, right?
Yeah, because you can have taxes withheld and things like that. But yeah, the purpose of this is just to get that self-employment tax lower, right? Because now you don't have to worry about paying that on this total amount that you have up here on this 150. It's only on whatever you payroll yourself. So yeah, you're right. But yeah, this is an example of kind of how to structure your business now, since you're a business owner and you can kind of incorporate yourself. But yeah, we'll kind of touch upon this in a little bit. We'll kind of circle back. But really want to kind of get into is kind of how to build some wealth, right? With some of the money that you guys have saved up. Because at the end of the day, if you just have money sitting in your checking or savings account, it's not really doing anything for you, right? And there's a lot of ways you can use this to either save a lot on taxes by contributing to some tax deferred accounts, so some retirement accounts, or just investing that in some type of like investment account to earn some interest or some growth out of it. Meanwhile, you can use it later on to buy an investment property, to buy another business, or to do whatever you want with it in the future, right?
Hey,
Just
Matt.
want to make sure. Yeah.
There's a question in the chat.
Okay. Where can I see that? Okay. What would the taxes be on there? Okay. I see that. So I'll go back right here. So the taxes in this example, it's whatever, right? Federal and state taxes change all the time. So in this K1 example, you would just have to pay federal and state tax on this $100,000 that's in your K1. So both of them, you would obviously still have to pay federal and state. I use this example and only pointed out self-employment tax because this is where you're going to be seeing a lot of the savings from, is by only paying the self-employment tax on this side. But you would still have to pay your federal and state on this side. So I don't know the exact dollar amount, but it's whatever tax bracket that would be in.
It's $800, I believe.
Mm-hmm. That's a good question, though. Okay, so let me go back into this one. So like I was saying, to start utilizing some of this money, right? So when it comes down to investment accounts, there's three different types, right? And I like to kind of draw these out in these three different boxes. There's what's called pre-tax or tax deferred, after tax, and then taxable, right? So the first two are what's considered retirement accounts, right? So within retirement accounts, there's what's called pre-tax and then after tax. So some examples of that pre-tax or tax deferred accounts are like IRAs, SEP IRAs, solo 401ks, right? Some examples of like Roth, or some examples of after tax retirement accounts are like Roth IRAs or Roth 401ks. So they each have their tax advantages by doing so, right? But some similarities is both of them you can't touch until you're 59 and a half without getting a 10% tax penalty, right? The second one is the grow tax free, right? So when you invest the money and it grows and you get the interest and the growth from it, each and every year it's tax free. The difference is the money that you're putting in on the left one, that pre-tax or tax deferred account, that's all going to be tax deductions for the year. So this is a good kind of thing to bring up right now, because a lot of these accounts you can actually open up until April 15th of the following year. So say you have up until April 15th of 2021 to open up one of these accounts, contribute to it, and still count as deductions for 2020's tax returns. So usually what happens is you would go do your taxes with your CPA, right? A lot of the times your CPA would use this as an example to save a little bit on taxes and say like, hey, you want to put $5,000, $10,000, whatever the amount is, into one of these accounts, and then you fund your retirement account. So how they differ is, since you're getting those tax benefits today with this pre-tax or tax deferred account, you pay the taxes later once you turn 59 and a half, or when you withdraw the money afterwards. The other account, that after tax or the Roth accounts, those you don't get any tax deductions by doing so, but at least the money can grow tax free And then once you withdraw the money after 59 and a half, that's when you get those benefits, because you don't have to pay any taxes on the withdrawals from that amount. So it's kind of a balancing act, right? The pre-tax one, you get tax deductions today, and then the after-tax, you get tax-free money in the future. So my most successful clients have all three of these accounts, just because those first two retirement accounts give you tax benefits, right? So it's money that if you just have saving in your savings account, or if you're looking for more write-offs or tax deductions, that pre-tax or tax deferred accounts are a great way to kind of do that, and which a lot of business owners do have and do contribute to it every year. But yeah, and this last one, a lot of people are like, hey, Matt, well, these are great ideas as far as like taxes goes, but I also don't want my money to be locked up or in these accounts until I'm 59 and a half, because I have plans for it, right? I want to buy a home, or I want to buy investment properties or another business, things like that. So this last one, or this non-retirement, it's just a normal investment account, right? The great thing about these is they're liquid. So you can contribute to these accounts, you can fund these accounts, you can invest these accounts, let this money grow for you, accrue interest, right? And then at any point you can liquidate them and then use this whatever you want, right? It's called a taxable account because if there is gains in the account, so the profits that you made from the investments, you do have to pay taxes on those, right? But at that point, it's profits that you wouldn't have seen anyways if you're just leaving it in your savings account, right? So yeah, both, like I said, my most successful clients have all three because they're utilizing the pros and cons from each one, right? Or the pros from each one. So everyone's situation is a little bit different. So I always like suggest to kind of reach out, and then we can kind of go through this individually if that's something that you guys want more clarity on. But for the most part, these are the different types of investment, and more specifically, some tax deferred accounts that would be good for taxes since tax season is coming up.
Awesome. Thank you so much for sharing.
Yeah.
Okay, we have a little bit of time, and I think we're going to spend a lot more time on the case files.
Okay.
So I'm going to bring different scenarios on the case file, and I want both Matt and Chris to feel free to make any comments on them. All right, so let me share. Okay, so this is just to bring where we at? Okay, awesome. Why are they not coming up? Okay, so a case file is basically a scenario, and then let's talk about what this person can do. An entertainer, that generates $10,000 income per month, 120 per year, how this person can show income to qualify for home?
Okay, Gary, do you want me to go ahead and take that first?
Yeah, go ahead.
Okay, so I'm just going to assume here, again, for just simplicity, that the borrower has no debt. And so they come to me and they've got $100,000, I'm sorry, $120,000 a year income, $10,000 a month. So we're going to use all that income to qualify. Before I get into the final, I kind of wanted to just let people know there's really three ways that you can qualify for a loan. The first way is full documentation. Second one would be alternative documentation. And then the third way would be stated income. So the first one, which we call full document, that is where people are going to show all of their income. They're going to show their tax returns. If they're payroll, they're going to show their W-2s and pay stubs and that sort of thing. That is normal financing. Through Fannie and Freddie Mac, you're going to get the best pricing. Someone who's coming to me wanting full doc right now on a purchase, they're going to get roughly about 3% on a 30-year fix, depending on their FICO score. They could get below that, but you're roughly going to be about 3% on full doc. And again, full documentation means you're going to supply all documentation to prove the income that you have. Now, the second class that you can get in for qualifying would be alternative documentation, where now we have hybrid loans where we allow borrowers to show bank statements over the last 24 months to prove their income. And what do we mean by that? So if someone is going to be showing me their bank statements, I'm going to take the average of whatever they deposit into their bank account. And this is really a perfect program for a lot of people who are self-employed, based on what Gary's talked about earlier, where you're trying to really minimize the tax that you pay. You shelter a lot of your income, so you generate $240,000 in income, but you really show to the IRS only $30,000. And he is correct that you're doing yourself a disservice, but I'll talk about that later. So that borrower really does have the income because they are truly making that $4,500 rent payment. But because they have their taxes set up where they are showing so little taxable income, they're not qualifying for what they want. So we use these alternative document loans where we average their bank statements and we don't look at their tax returns. We don't even want a copy of it or their pay stubs or anything like that. We just want their bank statements from their business account to show what they're putting into it. And if they truly are putting $20,000 a month deposits into their account, what we will do is we will give them 50% of whatever their deposits are. The assumption is the other 50% is for the expense ratio of whatever they're doing for their business. So in this example where someone is making $240,000 a year of deposits, which is $20,000 a month, we're going to give them 50% of that, which is then $10,000 a month, and that's what we're going to use for qualifying. Now those rates, because they're alt doc, there's a little bit more risk for the investors. They're not done through your normal financing through Fannie Mae and Freddie Mac that I'm sure you've heard of, or even FHA for that matter, or VA. These are going to be what we call non-QM investors or non-qualified mortgage investors. And they will allow for that, but they're going to price up because of the risk that's involved. And these non-QM investors are really just equity wealth groups throughout the nation that have pulled their money together. They're looking to get a little bit bigger return on their money for their investors because their investors are giving them money for a better rate of return than they would get in some other investments. So those rates are hovering right about 4.5% on a 30-year fixed, again, depending on your FICO score, but you can see the jump in interest rate because there's more risk. I wouldn't assume the interest rate is really the thing that you should concentrate. It should be more of, can I purchase property? Can I get into property now and correct whatever situation I have so I can show more income on my taxes so then I could refinance into a better rate, but secure the property. 4.5% might seem high in today's market, but I can tell you just 2 years ago, that was prime rate. People were getting 4.5% just 2 years ago on full documentation. So it's all relative. So that's alternative doc. The third way you can do it is through stated income. Stated income is going to be the most risky for anyone. Fannie Mae, Freddie Mac, FHA, VA are not going to do that, period. Most all non-QM players are not going to do that because they want to have some sort of verification of what kind of income you have. Stated income is a very risky product. It's what we had back in the early 2000s all the way up to 2007, which led to the Great Recession, when the mortgages kind of started to surface as just bad loans. So the government's kind of steered away from them. Doesn't mean they're not around, but they are. You just have to find them. It's what we call hard money. It's what I call Guido on the corner because that's truly what it is. It's just some investor who's looking to really make a large profit. These loans can hover anywhere from 6 to 6.5%. They're not going to give you a 30-year fix. It's going to be more short-term financing. You're probably going to pay a couple points up front, but they are available. And some people are okay with that because, well, for them, they want to have the ability to buy so they can start getting the tax shelter. So I just wanted to lay that out there for people to understand there's 3 ways of qualifying: full documentation, alternative documentation, and then stated income. And as you go down the slide, of course, the interest rate is getting higher. So bringing it back now to the question of what can this person or entertainer get who's making a $10,000 income. So if he was coming in for full documentation right now, and I'm going to assume no debt, and the guy has 20%, that he can put down. So someone who's coming in front of me with that kind of income is actually going to qualify for a sale price of about $1 million on a single family home, putting 20% down, which is $200,000, and they would have an $800,000 loan. They would qualify with that income. Now, if you go into the alternative documentation, because the interest rate's a little bit higher, and I can still prove $10,000 as your verified income through bank statements, you're going to qualify for a purchase price of about $800,000 with 20% down. And then that person who's doing stated income, well, they can qualify for whatever they want, but if they were putting $10,000 down as their qualifying income, they're going to qualify for about $700,000 as a purchase price. So this income will qualify you, but you can see if you're able to get into that full doc realm, the highest one, you're going to qualify for more. You will get up to the more $1 million price point. Now that might not be where you want to be. And that's one of the questions I ask the clients up front when I'm doing my analysis is, what is your comfort zone? It's not so much what you qualify for, what is your comfort zone? Where do you want to see your mortgage payment? And so we can map out that strategy for you right up front so that you're looking for properties that you should. So those are really the three classifications that you can qualify for. And then based on that, this person, again, full doc is going to qualify for $1 million home, 20% down. Alternative doc, $800,000 home with 20% down. And stated income, it's going to be about $700,000 with 20% down.
Hey, Chris.
Yes.
There's a question in the chat.
Okay.
You just read the question to him.
Yeah. What would the mortgage look like for documented income on a $1 million single family home? I'd have to run the numbers, but just real quick, if you were able to get, let's say, a rate of 2.75, which you should be able to get if you had a 780 FICO score with 20% down at this price point, your property taxes are roughly about 1.25%. So 2.75 plus 1.25 gives you 4%. Your insurance is probably going to be about 0.35. So that's what you can use to kind of determine what your monthly payment's going to be. So I use it as a really quick gauge. I'm just kind of sharing so you guys have some tools that you can take away. So that's about 4.25% of whatever you're trying to get. So if you're looking at $1 million home, 4.25 of that is $42,500. That's on an annual basis. Your monthly payment, divide that by 12. You're looking at about $3,500 a month, thereabouts. I say thereabouts because it's really dependent on your FICO score. As Gary said earlier, credit is really key when you're buying a home because it's going to determine what interest rate you get. The lower the FICO score, the higher the interest rate. The higher the FICO score, the lower the interest rate. It just goes into risk level to the investors. But I hope that answers your question.
Okay. Thank you so much. Matt, because we're running short of time and we have about 5 more case files to deal with, I'm going to limit the answer to no more than 2 minutes from both of you. So Matt, for somebody that's generating this $120,000 a year, and it's just, from their entertainment, performance and stuff like that, how can you help this kind of person with financing where they can show income, because this is all entrepreneurship income, right?
Yeah, I mean, the best way and the example that I showed earlier was just to set up your LLC and get incorporated, and establish that S Corp, and then to payroll yourself as far as that goes, to save on taxes. And then just depending on when you're looking to qualify from home, just to show how much income that you need. Because I actually had a question for Chris. If you, how much of income history would you need? How much do they look at as far as like income history? Is it like a year back or can they just be showing this a few months out until they want to qualify? Because that's a popular question I get. I always had a question on too.
So typically it's 2 years, whether it's full doc or alternative doc. Full doc, we're going to look at 2 years tax returns and cash flow average. And the same thing for alternative doc. They're looking for 24 months bank statements. Best case scenario, if you've got a borrower who's been employed for 5 years with a business, you might get a waiver through Freddie Mac that would allow us to do a 1-year tax return. But that's something we don't know until we run it through the system. But for you, Matt, if you're going to advise your clients, 2 years.
2 years? Okay. Sounds good.
Okay, case file number 2. Independent contractor, get deposits of 144,000 income per year average. Deposit is $12,000 a month. How does this person write off expenses and create an income? Anyone want to take on it? But please, 2 minutes maximum response time.
Yeah. So the way that works is obviously you have your gross income for the year, so that would be that 144, and you just have all your business expenses that would get written off from there, and whatever that net income is or that net profit for the year, that's what you're going to be taxed on. So that's how you want to start setting up that LLC and then S Corp and be incorporated and seeing how much exactly you want to payroll yourself. And it's all going to be depending on if they're looking to buy a home, right, in the next 2 years. Do they want to get that income a little bit higher to show more? Or do they want to, is it the sole reason just to save on taxes? Then they want to get that as low as possible within the guidelines and to save a lot on that self-employment tax. So as far as how they write it off, just to keep a log of all your expenses throughout the year. I'm in 1099 as well. I just keep an Excel spreadsheet. A lot of the things I recommend is just having a different credit card or a different card that you do use for all your expenses throughout the year. So it kind of keeps it nice and organized. I use Chase for an example, just because they, at the end of the year, they kind of categorize all your spending. So you can see like, you use 12% in automotive, and it breaks it down as far as like gas and all these different things. So there's a lot of different cards that you can use to keep that a little bit more on track. But that's something like you would have to talk to your CPA as far as like what qualifies as an expense for your business and things like that.
Okay, thank you. Chris, any comment on this one? It sounds like
this is more of a tax thing. So
yeah, tax thing.
It's done before I even see it.
Okay, so Uber Lyft driver generating 6,000 a month with 3 kids. How does this person get to buy? Because I think they're on 1099 for Uber Lyft driver, right?
Yeah. Oh, so if they came to me, it's really like, how did you do your taxes? So you've already gone to your tax person. I have to assume that that's their income, 6,000 a month. If you didn't do any write-offs. Now, of course, you might have write-offs, but the way it's saying you're generating 6,000 a month and you have 3 kids, what would you qualify for?
So I guess the question here is for somebody like this that have family write-offs, instead of what can they do if they have family that they can write off as opposed to writing off their businesses, and now they're showing $15,000 income? What can you advise somebody like that? And this is what you can do so you can use all of your income to be able to purchase a property.
Well, first of all, I would say that that's more of a CPA question. I really can't give you tax advice, but I would assume if this person, has 3 kids, they're going to get the tax credits for each kid. They're going to get their own personal exemptions as well. And if they don't own a home, they're better off trying to show as much income as they can so they can qualify for what they want. But if someone had a $6,000 income and they wanted to get qualified, they're probably going to be qualified for somewhere in the neighborhood of about $550 as a sale price on a home. So, I think you said it a few times earlier, and I kind of want to hit it again. I mean, people have to make that decision. Do you want to buy a home, or do you want to just get tax breaks? Because as you said, the tax breaks are great for that year, but you're really limiting your building of your wealth, of being able to purchase property and letting that grow for you, because real estate is the single greatest investment that you can make over a long period of time. So, to the answer, 6,000 a month, you're probably looking at about $550 sale price.
Awesome, thank you. Okay, I guess we asked the question already. Let's get to the next case file. All right, restaurant owner. I think both of you can come on this. Generating $24,000 monthly with expenses. What's the best cost of showing their financials?
I would say more than likely, I get this client a lot. This is the bank statement loan because they have a lot of expenses and their net income is probably low. You just want to go 24-month bank statement. This person is generating 24,000. I'm sorry, yeah, 24,000 a month in deposits. Again, I'm going to give them 50% of that for qualifying. That's 12,000 a month. They're qualifying for well over $1 million on a purchase price. Now, of course, now we have to look at their FICO score and what other debt load they have, but that's probably the best way for them, because more than likely this borrower that I see all the time writes off a lot of expenses, and their net income that they pay themselves out with a K1 or maybe even a W-2 is a lot less than 12,000 a month.
All right, so Matt, can you comment on this? Because yeah, we do get people like this quite a bit. And what could they have done differently with their corporation and stuff like that? Because normally restaurant owners, they are like just business owners. They don't have a corporation, you know, but they do have employees they're paying. So what could have they done differently to make sure if they want to, you know, because like Chris is saying, you can either buy as a statement, you know, but you're getting 4.5% compared to 3%. So I find people caught up with, oh, I really want to buy. Yeah, but I want to get the best rate possible. What could have they done different to make that happen?
I don't know if what they could have done differently. I think Chris kind of just summed it up as far as like the different options that they have for qualifying for a home, those 3 different options. Do you mean as far as like their business structure goes?
Yeah, the business, you know, if they, because if they do it as a, you know, self-employed business person, as opposed to if they set it up as a corporation, that's probably where I want you to talk about. Yeah.
Yeah, I mean, it all depends on like how many employees that they have, kind of what their net profit is for the year, right, after all the expenses. Because sometimes it doesn't even make sense to do that because that costs outweigh like the tax savings that they're going to be paying for that. But I mean, it all depends. But I would always recommend, especially for like 1099 and people who maybe don't have that many employees and it's just kind of you and maybe you have like a payroll or two. That the S corporation is probably the best way to go. But of course, it's all depending if you're looking to show a lot more income, then you maybe not want to do that, or show your W-2s a lot higher so you can qualify for that home that you're looking for. So it all depends on like when they're looking to buy a home, if they're looking to buy a home or things like that.
Awesome. Thank you very much. We're coming to the end. Okay, I think we'll end with this one. Owner of multiple properties generating 20,000 in rental income with 1 month to claim on taxes. What is the best way for this person to show financial income? So now this is somebody that owns a few properties that's generating $20,000 in rental. Again, I get people in this position. Again, they're still writing off everything. So what can this person show to qualify to get in regular, to be able to purchase income property? I mean, they've got 20% down, no problem. It's just, how can they show better in this situation?
So from the qualifying standpoint, we have to look at their tax returns. Anytime people own property, I'm going to get their last 2 tax returns filed. So right now we're looking at 18 and 19, and we're going to look at what was called the Schedule E. That's your real estate schedule that you're going to put all of your income down. You'll list your revenue, less expenses, and you'll get to a net income. But we don't just go off the net income for that. We're going to look at the cash flow. So there's certain things we're going to add back. And typically, and I'm going to assume that you've got a really good CPA that's done your taxes, you probably have written off some sort of like on the Schedule C that you're taking deferred maintenance and stuff like that. And we're going to add back a lot of stuff on your taxes. So this is more of a complicated question to answer, but we're going to look at the last 2 years Schedule E income and try to average it over the last 2 years to get you to qualify. But you are going to have a qualifiable income. So if if you have no other income, and that's what I'm assuming here too, it's just straight Schedule E income, you could still qualify. The bigger question is going to be, are you buying this as an investment? Are you buying it as an owner occupied? That sort of thing. But you can definitely use that income. I can't tell from that question how much, because you got to look at the tax returns and cash flow. So, you know, that's kind of what we do. And we do it free of charge for you up front. If you're seriously thinking about purchasing, the best thing to do is contact Gary and see if we can schedule an appointment. Let me take a look at your tax returns. Let me cash flow you and see what you guys can qualify for.